The first step in the preparing consolidated financial statement is to do the acquisition analysis. So in this video clip, acquisition analysis, we're going to look at the acquisition analysis for the Delphinus Telescopium group. Now, from the question, we identified what we need for the acquisition analysis. We start off with the subsidiary's equity, which is equal to the net assets. If you think assets less liabilities equal equity. So we can use our equity as a starting point. Then we focus on the identifiable assets and liabilities. Therefore, we'll see that items like goodwill will be excluded or subtracted from the net asset value because we only include identifiable assets and liabilities. The information on the inventory and the machinery, the fair value adjustments, as well as the unrecorded liability, also needs to be considered for the section calculating the fair value of the net assets. And then the part here at the bottom on the consideration transferred is the information that we use when calculating how much we've paid for our share of the net assets. So the acquisition analysis will look like this. It is done on the acquisition date, the 1st of July 2014. We first of all calculate the net fair value of the identifiable assets and liabilities of the subsidiary. So starting with our equity, we saw that the inventory and the machinery had to be revalued to their fair value, and there was an unrecorded liability with a fair value of $5,000. Because we applied tax effect accounting, and with these valuation adjustments to, or fair value adjustments to the value of assets, we see a change in the tax base versus the accounting figure. So therefore deferred tax liabilities or assets are recognized with regards to these fair value adjustments. So our after-tax adjustments to our equity brings us to a net fair value of $112,500. So that represents the net assets of the subsidiary valued at fair value. We now have to see how much did we pay for our share of the assets, which in this case is 100%. So we know that our value investment in subsidiary has been valued at $147,250 in the financial records of the parent at the end of the financial year. However, between the periods since acquisition date till the end of the financial year, a call was made for the balance that was still outstanding on the issued shares, 25 cents times 100,000 shares. So that adjustment is reflected in the closing balance of our investment in subsidiary account. So therefore we subtracted or excluded from our investment in the subsidiary to get to what we've actually paid for our share of the assets and liabilities of the company on acquisition date. So by comparing what we've paid for our investment to what we got, we can see that we've paid a premium, and therefore we will record goodwill from a group perspective. That goodwill is not recorded in the accounting records of the parent straight into that, but it's actually recorded in our statement of financial position for the group. Looking at our acquisition analysis, we can then identify the BCVR entries that will be made on the day of the acquisition. So we'll have a revaluation of inventory, machinery. We will record the liability for the provision for damages, and the acquired goodwill will be recorded against BCVR. 6 months down the line, we now have to see whether there's any inventory on hand or whether the inventory has been sold, and that would determine whether a BCVR reserve is still raised for that or created for that. Same with the machinery. The machinery, we have to, if the machinery still exists, we will do the BCVR entries relating to that. If the machinery has been sold or fully depreciated, that needs to be considered. Further to that, we will raise the liability against BCVR and the acquired goodwill. So let's number them 1, 2, 3, 4. And in the next video, we're going to look at the BCVR entries for these 4 items.